Have you ever looked at a stock and thought, is this actually a good deal? Instead of guessing or relying on internet hype, what if you could calculate its fair value in just a few minutes? Today, I'll show you how to build a simple, powerful dividend valuation model in a spreadsheet, so you can make smarter investment decisions fast. Welcome to the channel. I'm the Swedish dividend investor, and today I want to show you how to build a quick dividend valuation model using spreadsheets. Alright, so what we are doing today is a Gordon growth model. The Gordon growth model is one of the easiest way to estimate a stock's intrinsic value based on its dividends. It's simple but powerful, helping you determine whether a stock is fairly priced or not. However, it does have some limitations, so I will also cover how to use it wisely. Because the model assumes a constant growth rate, it is generally used for companies with a stable growth rate in dividends per share. We can see the calculation right here. I want you to understand it so you know what it does, but I will show you how to make this model in a spreadsheet, so it will do the calculations for you. So let's just dive right into it. We will open a fresh new spreadsheet and start with marking B4 and just write company. And C4, we can type GGM. Don't worry about the looks of it. We can fix it later when we're done with the calculator. B5, we will type PPS. Going to B6, enter dividend. This is their current dividend. B7, assumed growth. B8, next year dividend. B9, rate of return or required return. B10, margin of safety. Jumping down to B12, fair price. And finally B13, MOS or margin of safety. Heading over to the calculation. For C5, we will type equals Google Finance, open parenthesis, select or type B4 and close parenthesis. If you write the ticker for the company in B4, the stock price will get pulled from Google Finance. Next one is C6. We will just mark this in a color, indicating we have to type something here. We do the same with C7. For C8, we will enter equals C6 multiply open parenthesis 1 plus C7 close parenthesis. So we will get our next year dividend based on our assumed growth. We will leave C9 and C10 alone for now, but we could give them color, so we know we have to fiddle around here. For C12, we're going to enter equals C8 divided open parenthesis C9 minus C7 close parenthesis. And that equates to the next year dividend divided by required return minus assumed growth to get a fair price or an intrinsic value. For C13 we go equals C12 minus open parenthesis C12 multiply C10 close parenthesis. This is to discount the fair price with a margin of safety. Since this model assumes growth in perpetuity, we could be way off. This is almost finished now. We select C7, C9 and C10. You can mark each one together using Shift and left click. And we click on % format as shown here. Choose C5, C6, C8, C12 and C13. And go up to format, choose numbers, and if you have it, choose US dollar. If you don't have it, just go custom currency and find US dollar. Now this is ready to use. You can enter the growth, required return and margin of safety yourself. But we're going to make this a bit more aesthetic looking, so we will use drop down menus for the numbers instead. Alright, Time to fix the data for the assumed growth, rate of return and margin of safety. Just scroll down so we're out of sight for the calculation. To make things look neat, I choose B50. Here we will mark B50 to, let's say, B68, depending on how detailed you want the growth to be, and choose % format. Now, you could do this however you like. I'm just going to show you how you can use this. Start with B50. We will go 1, B51, 1.5, and so on until you're up to 10%. At B49, we will just enter assumed growth so we know what the numbers are. Select C50 to C64, % format, and go with whatever rates of return you would like. I would go like this, 5, 5.5, 6, and so on, up until 12.50%. Finally, we mark D50 and D70, choose % format, and just go from 0 to 20%. That's the numbers. So we head up to C7, right click and choose drop down menu. Change the criteria to drop down menu from range. Click the choose range button. Mark B50, hold shift and left click B68, or wherever your numbers ended, and press down. Now we can see we can just choose from the list here. We will do the exact same thing with C9 and C10, and use their respective numbers as well. Now, if you just want to use historical numbers, let's just say assume growth of 3.56%, just copy this model, mark E4 and paste it. Right click F7, choose drop down menu, scroll down, choose delete rule, and now you can just type in whatever number you want. Now, to make things look a bit better, just select B4 to B13 and press bold. And a background color, let's say gray. Mark C4, C12 and C13 and go with bold. Just click C4 again and choose the background color of gray. Next we mark the whole model and go to borders. Border style, choose the fat one here and select outer borders. And finally we go to C12 and C13. Let's color the background to green. And there we have it. Now for a final move, we will first rename the page to US dollar or USD, and then copy that page and rename it to euro. And let's do it a final time for your currency of choice. Go to the euro page, select all the cells with dollar in currency. Choose format, numbers, and euro. And the same for your currency. Now you have a quick and easy way to value dividend stocks. There are some downsides to using this. The first one is the perpetuity growth. I mean, trying to project growth 10 years ahead is hard, but forever, impossible. That's why we have to use low inputs. Second, there are other forms of value ignored, such as buybacks. And third, it's only suitable for dividend paying stocks. But I would rather want you to use this model than to go with gut feeling, planetary alignment or other superstitious indicators. Maybe use it to get a quick look and know if it's worth digging deep into it. So now you know how to do a quick valuation of a dividend stock. Let's do a quick example. Let's go with Realty Income. We're going to use the current dividend of $3.22 and check their historical growth for the dividend. 3-year compounded annual growth rate of 4.02%, 5-year CAGR of 3.55%, and a 10-year CAGR of 3.96%. So, We will head back to our model, mark B4, type the ticker O, enter the dividend, and I'm going to go with a growth of 3.5% from the list. Rate of return 10% and margin of safety 5%. Fair price of $51.27 and $48.71 with a margin of safety. Compare that to the stock price and we can see it's a bit overvalued. To just see what would happen if we buy now, changing the required return, we can see that the stock is fairly priced for a 9 to 9.5% return. Let's go back to 10% required return and just make the growth to 4%. We can see the fair price jumped to $55.81 and a margin of safety is now $53.02. That's why we have to be very careful with our inputs. I would say the higher the assumed growth, the higher you should put the margin of safety. Remember, this isn't the growth for a couple of years, it's in perpetuity. You also can't use higher growth than the required return, since that would result in a negative number. But honestly, what company grows their dividend by over 10% forever? None. So, now you know how to do a quick valuation of a dividend stock. If you found this video helpful, hit that like button and consider subscribing. It really helps the channel and lets me keep making content like this for you. That's it for this one. I'm the Swedish Dividend Investor and I will see you in the next one. Ha det gött!